Thank you everyone for joining us on today's Ripple Ventures Tank Talk on venture and growth capital investing and the outlook on the Canadian tech scene with founder of OMERS Ventures and co-founder of the Council of Canadian Innovators, John Ruffolo. His claim to fame is being focused as being one of the pioneers in the Canadian tech ecosystem for launching OMERS Ventures in 2011, having invested over $400 million in over 35 disruptive tech companies, including Shopify, Hootsuite, Hopper, PasswordBox, and the list goes on. He is currently still the co-founder and vice chair of the Council of Canadian Innovators. So thank you very much for joining us today, John.
Great. Thank you, Matt.
So let's kick it off. So first off, we want to get into VC and growth capital and where it stands today. So obviously, given the historic run in private market valuations for the past decade, prior to COVID, how are you thinking about the private markets?
Sure. When I look back over the last 10 years, and let me just focus first on the venture capital markets, and that includes the growth part of the venture capital markets or late stage venture, and then I will move over to more private equity. On the venture capital side, after the recession of 2008, 2009, 2011 was really the first great vintage year of the next VC run. And it was really predicated off of the technology disruption that really crossed the chasm in 2008. And this is where you had the intersection of three massive technologies being mobility first, cloud computing, and social, all crossing the chasm at the same time. So 2011 was the beginning of the great run. And that run, from a valuation entry point perspective, really lasted until the end of 2014. And in and around 2015, started to see the big supply of capital coming into the venture landscape. And I would say to you, although prices started to materially go up starting in 2015, the supply of quality deal flow continued to come in because you're still taking advantage of the 2008 technology introductions of those new technologies I just mentioned previously. But sometime around 2017, you really started to see not only the increasing of supply of capital in that sector, you started to see a lot of crossover funds and tourist company capital come into there. And so what you really started to see is not only very, very high entry points, but you actually started to see a decreasing number of new types of technologies in business. Not that it's a criticism, it's just a reflection that the cycle has run 10 years. And, Matt, you and I had discussed, my prediction really going back from 2015 that 2020, and I was being very specific in the latter half of 2020, was going to see the implosion of the venture cycle, not because it's a bad thing, it's just because it's a natural ebb and flow. The one thing I didn't know what the trigger was going to be. I thought it was going to be the U.S. election that was going to basically let the air out of the bag. It ended up being a virus, but it's the same result. And you see the same thing on the private equity side, particularly on the buyout side. And the difference on there is a lot of the high prices were really triggered by the debt leverage that was being used and really having an arbitrage of the two. So in both cases, both buyout private equity and on venture capital, you've seen high prices that I believed after 2020 were going to revert back to their long-term mean.
Yeah, I actually will give you credit, John. I remember when we were sitting physically in the tank, when we were allowed to meet in person, and you said Q3 2020 will be the first time I write a check into a private company.
Right.
I remember that. So yeah, very good call.
Right result, wrong reason.
Yeah,
I'll take it.
Yeah, and so just to dig into that, we've heard a lot about this tourist capital coming and going. Yeah. And obviously it left the market for what, 3 weeks maybe in March, but it looks like it's come right back in and it doesn't seem to have stalled. Maybe the speed at which it's coming in has slowed, but it doesn't look like it's completely disappeared. Are you
Yes.
shocked by that?
Nope. No. Um, you know, a few reasons. Number one, a lot of the deals that you're seeing that in our, more of the venture space, um, are deals that, and I'm ignoring early stage seed stuff for the moment, but they're based on looking at deals and building relationships, pre-COVID, and there's no reason why you would, decline those opportunities because a lot of them didn't have much revenues anyway to speak of. So I think it's a little bit more business as usual, and the real challenge will be the valuations that you perhaps were kicking around. Are they going to hold or not? And what I think you're going to see, and this is typical. This is now my fourth or fifth recession that I've gone through, and you are going to see a dislocation of price expectations on the bid and ask between investor and entrepreneur. And there is a lag effect. And what happens is that right now is that you start to get folks coming back into the market, hoping really that nothing has really ultimately changed. And I think what you're going to see is a period of volatility. And by the time that we get back into the new normal of, the economy opened, whatever the heck that really means, right. But I expect that into the fall time, we will then enter into the recovery period. But my belief is that recovery period will be represented by a classic 18 to 24 month recession. And as that time grows, you're going to see the bid ask spreads get closer together. Now, the deals that I do expect to occur right now are really distressed deals. And those distressed deals are generally not for lousy companies. These are generally for good quality companies, but for certain unique circumstances, they've hit a liquidity squeeze. And as an investor, you could see that is a temporary dislocation. I expect those deals to be done, and those are new deals being done. And based on the number of capital pools that I've spoke to, that type of deal is got to the highest priority in most multi-asset funds.
Right. Yeah, we're seeing the Silver Lakes of the world coming into an Airbnb and stuff like that. Yeah. Well, that leads into our
and debt funds are really at the top of that pecking order.
Yeah. So that leads into our next question here. So how are growth investors like yourself viewing valuation, given the constant flux in public market multiples? How are you thinking about pricing your investments today?
Okay. So let's talk about the public markets. I'm not a public market expert, but let me just give you my perspective. First of all, when we talk about the public markets, I think we got to be a little bit more specific. What do we mean? So if we're talking about the S&P 500, then you have to look at the weighting of the S&P 500 by, particularly the 5 massive technology companies, which are rather unscathed and in fact growing, in the case of Amazon, which is leading a big reason why it's only off, what is it now, 7% off of its high or whatever.
Barely.
Yeah. I do not think that is representative of the average stock. What I've been seeing is the dislocation is somewhere in the 10 to 15% range, not the 30% range either, which got originally hit. So I'd say that the public markets are not necessarily overvalued per se, but you just got to be very, very careful of what you mean. When I see in the private markets, like I said, I think that there is 2 fundamental pieces of the valuation equation. One is the forecasts of the revenues and expenses. The problem that you have for many of the companies, not all of them, is until the economy is reopened again, it is hard to really project what might be the new normal. And while it's not impossible, again, your bid ask as an investor versus an entrepreneur is a very difficult thing to determine. Will your market recover in the time frame that you think as an entrepreneur? And it's not a question of who's right and who's wrong. It's a question of neither of you really know. So either you're going to see some deals where you can actually architect that difference. You can actually put a milestone saying that if you think you can hit this, your revenues will restore to this level by this time, here's the valuation, or what have you. So it's possible to architect it. What I am seeing with a lot of folks is trying to get to that point of the economy reopening, which is probably going to be September or sometime in the early fall. And at least you'll have a little bit of insight on what is the reasonable forecast. That's number one. It's the second part of the equation, I think, is where the real controversy is going to be. And this is, what discount rate or what multiple are you assigning? And I would say to you, from 2015 starting, but particularly around 2017 to 2020, the average multiple or discount rates were mispricing the risk premium, largely due to an excess supply of capital and really chasing return. So the fundamental question, and Matt, this is what you and I discussed, will valuations from a discount or multiple revert back to the long-term mean? And to give you an example of that, the long-term mean of, say, a SaaS company multiples were 3 to 7 times revenue. A great company getting 7. You know, what we're witnessing today is a good company getting 15. So basically, with the exact same forecast, you're basically getting valuations cut in half. That's what it means. And when you look at the various industries, the technology and software industry in particular has commanded a very, very high premiums. When you start looking at other asset classes or other industries, particularly in the growth private equity area, very, very different multiples. So that compression is not as great. But I think on the software side, there is a lot of room for big compression of those multiples.
You're right. And it's so if I can summarize, it sounds like there's 2 points when you look at these investments. It's one, what's the liquidity requirement for the next 12 to 18 months? And is this enough capital to just get you through that? Because whether you're going to make it or not is a 0 or 1, right? You need to have that capital decision first. Secondly is on valuation and the ability to backfill that valuation with growth. And everyone sort of just threw out 10 times on every SaaS company for the last decade. And now people are realizing, well, 10 times was actually what the best of the best were getting 10 years ago.
Correct.
How could we justify that now for an average SaaS company, which should mean about 150 to 200% year over year growth if you're getting around 10 times. And if you're not getting close to 100% year over year growth, you're probably closer to maybe 5 times or even less.
Correct. And as well, too, exactly what you just said is, and I think the market has been very, very undisciplined in terms of the quality of the revenues as well, right? So that is in the classic, 80, 90% of margin type of revenues of a true SaaS business. The definition of SaaS, although it hasn't technically changed, people have been using MRR and ARR to approximate a SaaS business and then still attracting those valuations. I think investors are starting to look to really be far more careful on how to even assign those multiples in the first place.
Right, for sure. Well, I mean, for you as a later stage investor, now let's say you've got comfortable with valuation and capital injection. How are you building strong and deeper relationships without physically spending time with CEOs? As we know, people make a huge decision factor for them.
Yeah, no, this is a challenge. I would say to you, relationships that were pre-existing are a lot easier, so that you've already develop some level of trust, and you're keeping in touch, whether zooming in or periodic updates. It's the new deal flow is a little harder. So you never shut the pipeline, but at the end of the day, investing is a relationship business. If you were to ask me, would I ever invest without physically meeting somebody? I call me an old school guy, but I love the idea of having a beer, having a glass of wine, and really understanding the individual and understanding, how they feel about things. And those human conversations, I think, are absolutely critical. I'm a relationship investor at the end of the day, and particularly in the technology world, 70% of your bet is based on the team. And if you really don't have a strong relationship, it's really like getting married online with never ever having met someone beforehand. So I think that's what the delay is going to be. But I'm thinking, in the fall time, we will be back to, again, I use the word normal, but it'll be a new normal. But so it'll be a small delay.
Yeah, the marriage analogy is exactly what people have to think about it. This is a 10-year relationship. You can't get out of it. It's very illiquid. One of the VC funds I spoke to earlier today was saying, we have a pipeline, but it's only going to last us for a few more months from relationships we started 3 to 6 months ago.
Right.
So we'll see pipelines start to dry up. And for the founders on the call, I think it's important for them to hear that it is okay to reach out to people now to build relationships, even though you physically met them, but they may need to see the back of your head one day to know if they can trust you.
Yes. You know what? This is an excellent point, because I've heard people just say, I'm going to bury my head for the next 3 months. Absolutely do not do that. Why? Because the investors are also sitting at home too, and everyone's productivity is way, way up. And so do the 20 or 30-minute call, tell them what to do, tell them, what's going on, but know very well that you probably are not going to get a check until they actually physically meet you. So do all of that preliminary work up front. And as an investor, you never, ever turn off the pipe, because the moment you turn off the pipe, it just doesn't turn back on instantaneously.
Yeah, really good points, John. So, at Ripple, we focus heavily on being hands-on investors at the early stages. How do late-stage investors work with their companies and think about adding value? Sure.
So the interesting aspect of, the adding value part, it's the similar thing of, what's the worst words you hear a VC saying to you? Hey, I'm here to help. And there's a little bit of truth on this. So let me just get out the honest truth first. You know that there's a correlation between the quality of a company that's in your investment, and it's a negatively correlated with how much value or time you spend with them. And the reason is, if you segment your portfolio just based on what you know into the A's, the B's, and the C's, you generally have a few A's. These are the clear winners that you kind of thought they'd be a winner, but it's proving out to be one. And then there are the C's that, you made a thesis bet, but it's clearly, typically they're not getting the product market fit that you were hoping for. Those are easily identifiable generally. And, that's probably, 10% of your portfolio on the A's and 10% of the C's, or something like that. Those two categories are ones that you actually generally don't spend a whole lot of time on, because the A's are doing so well. A good job of an investor is knowing, keep your nose in, but keeping your hands off if things are going very, very well, and being there, when they need you. On the C's, it's a little bit more selfish. When you know this thing is going to die, you have to make some difficult decisions because you have a limited resources. It's the B's that are the hard ones, where you don't know, is the B really a B, or is the B on its way to an A or to a C? This is where you really try to focus it on the value. I do believe that with lots of work, you can try to help move a B into an A. And so the three areas that, based on, my discussions with portfolio companies where they need the biggest help, talent, number one, it's always an area that they need, and not just finding people, but organizational design and how do you align the strategy of the company with the KPIs and making the whole team working together. Number two is innovation. And by that, helping them, on areas of innovation where, although these are innovative companies, a lot of them are looking for, strategy and bouncing off on that. And the third area is on growth in particular. They generally don't need a whole lot of help on the product development. That's not what VCs are really good at. But what they're much better at is as you start to scale the business, and once you're past product market fit, and now you're starting to deal with areas that are not the core competency of the investee, marketing, sales, finance. These are the growth areas where VCs have done a better job on assisting the companies as they scale, as opposed to helping build an actual product. I mean, that is, when you're just coming in every so often, it's very, very difficult for an outsider to help. And frankly, that's the reason why I would have invested in the first place. So if the team is having a difficult time architecting a product, I don't see any VC coming in to help fix that.
Right. I think at the earlier stage, there's just so many fires going on that you're just trying to help and put out. At the later stage, you could be a bit more selective,
correct,
more sniper rifle approach. Before we move on, are there any C's that you invested in that became A's because of either something you guys helped out with or just shockingly turned into an A? If you don't want to disclose the name, that's fine. But
you know what?
That's okay.
Yeah, you know what? I think the answer is no. Is there B minuses that you thought were going to go into a C? Absolutely, yes.
It wasn't Shopify I was talking about, so that's fine.
No, Shopify is the perfect example of I put them in the A+ category. Is that I would love to say how the great value added work. I think we were a good investor, but man, like they just nailed their product market fit. They nailed so many things, but those are one in a decade investment.
Right. Okay, so if you were a seed and Series A founder looking to raise capital in the next 6 months, how would you prepare?
So the seed is going to be an interesting area. I actually think the seed is an opportunity where, in fact, capital was getting less scarce on the seed side because they were moving to the Series A and B. And I think that if I'm right and you accept what I said about the cycle, and there's going to be the next cycle coming in that will launch the next wave of investing opportunity, being a seed founder is the time for that next cycle. And frankly, if there are seed investors out there, they're not looking at the next 12 or 24 months anyway. So, I assuming a seed fund has the capital, it should be, not quite business as usual, but it really practically should be. On the Series A, Series B founder, I think it'll be a little bit tougher in that the Series A classic founder or classic investor is seeking where a company is clearly on path to achieving product market fit. And what they're doing is they're selling on a one-to-one basis, but it's clear that somebody's paying for it. And the Series B difference is flipping from selling on a one-to-one basis to selling on a one-to-many. In the last 5 years, that has slipped. And the criteria for a Series B in the last number of years really was what a Series A looked like. I think we're going to revert back to the long term again, in that if you are a Series A founder, you better show demonstrable product market fit. Again, on a one-to-one basis is fine, but I think that pressure is going to show up specifically there. And if you are a Series B, you really better show your ability to scale, which is really flipping into that one-to-many. So I think the bar has gone up, or has reverted back, I should actually say, not even gone up.
So to summarize what I think you're saying, so everyone understands on the one-to-many aspect is, you put $1 in, you get $1 out. You put in $1 on a Series B, you better get $3 or $4 out in terms of the multiplier effect in your investors.
Yeah, and the reason is that all of a sudden you're scaling through marketing, through different distribution channels, multiple sales force. So you're getting true scale. And the word scale is an accounting concept. All it really means is that when you're an earlier stage, is exactly what you were just saying, is that you got one person, you got one sale. Now you've got 10 people, but you better have 30 sales. And so your expense line is growing slower than your top line. And that's what you have to really see, particularly once you hit the Series B.
Yeah, for sure. Metrics really matter. So now what everyone really would love to hear about is, your outlook on the Canadian tech landscape. So, how has your view on the Canadian tech scene developed since you started OMERS Ventures until we are at now?
So I would put it into two different categories. So it's the 2011 to 2014 phase. Again, in 2008, the key three technologies that crossed the chasm at the same time was mobility first, cloud computing, and social. And they all kind of started at different stages, but it was quite fascinating to see it in our previous downturn. And what was happening from 2008 to about 2010, you had a number of founders that were trying to figure out, what do they do with these technologies? And there was like almost no capital around. So it was a little bit to the adage of necessity is the mother of invention. And the technologies or the businesses that they were building were really looking to get to profitability very, very quickly because they didn't have lots of sources of capital. And they were seeking product market fit very, very quickly. And at that time, the technologies were relatively new. So there was a number of years where almost everything you were seeing is like, oh my God, I haven't seen this before. Starting around 2015, when the influx of a lot more capital came in, you started to see glimmers of incrementalism. And then by 2017, it really became incrementalism. So everything became, we are going to be the Shopify of this or that, etc. And really, instead of moving things 10x or 100x better, I can deliver a pizza in 30 seconds faster. Like, well, who the hell cares? And again, it's not a criticism. It's just the ebb and flow of a cycle. And so I would say to you, this cycle, I believed, was going to run to about 2020. And then I think the cycle was going to have a very, very tough time for about a couple of years. But this is the time of new technologies really trying to make their mark. So let me give you a couple of examples. So by 2017, as I started to see the cycle already shift, I was already focused in on what's out there on the next cycle. And the two examples, and there's many, quantum computing, truly blockchain. These are things that still haven't been realized. But let's just say if quantum becomes real in the next cycle, we're going to have another unbelievable massive wave of creative destruction. Those are the unbelievable times to be investing in. And so the real question will be, I'm going to be spending a lot of attention to really look at new technologies that really have paradigm shifts as opposed to incrementalism or just changing slightly business models. Not to suggest those are all bad ideas, but the bar for those will become extremely high.
Yeah, it's kind of like when original venture investing started, it was first based on like, the microprocessors, silicon chips and stuff
Right.
like that. And then there was all these tertiary businesses that got developed off of it. Same like mobility and then the apps and stuff like that. So you're saying quantum could be the next 100x, wave
Yes.
to come. And then you'll see a bunch of small tertiary incremental businesses started off of that.
Yes. Otherwise, if there's not, if all we're doing is just simply, incremental improvements, what the problem is, the incumbents have a massive advantage on that because they have the resources to continue to either buy or incrementally improve themselves.
Right. Yeah, for sure. So how has the early stage Canadian startup ecosystem matured, in your opinion, in the last decade? And what do you wish we did differently?
I can tell you, so I've been through, the .com bust, and, the issue there was, that cycle really started about 1995. And, what was the technology that really unleashed it? It really was uh, the, the Mosaic browser, which became Netscape, that really was the crossing of the chasm and really unleashed the whole .com. The problem there is by the time we really started getting going, it was about 97, 98. And this is when venture capital funds started really raising some decent amount. And by 2000, 2001, very good amounts of venture capital were raised. And then boom, it got hit. And the problem was there was not enough of maturation in the technology ecosystem and the funders to really sustain itself. So by 2005, it was like crickets. It was a desert. And that's why by the time in 2011, when I built OMERS Ventures, it really was the only game in town. And thank God that OMERS was willing to take that bet with me. But there was almost nothing to co-invest with. We have a very different situation now. Far more startups, far more people involved in the sector, and far more sources of capital. So the real question in my mind is the next 18 to 24 months will likely not be very pretty, but we got to get onto the other side. And if we can get onto the other side in preparation for the next wave, we are going to be very, very well positioned. So, the key thing for us is just to try to protect as many good companies as possible, knowing very well that the unsustainable companies, and a lot of them probably should fall apart, but the healthy part of that falling apart is that it will unleash lots of talent to join the perceived winners. So we do have far more now. So I am more optimistic now that we'll get through it, but there will be short-term pain.
Right. And we talked about this before in terms of how the way we compete with the US is, one, we build companies well, but we sell them too early. And the other thing we're still struggling with is getting people to leave Bay Street, to leave those golden handcuffs and come work on Main Street with some of the startups to help them scale faster with that, C-suite expertise. Are you seeing that starting to change now with people willing to take those cushy jobs, leave them and go work for startups, or not yet like they have in the States?
Yeah, you know what? That is going to be a good question. I mean, just generally speaking, we're more conservative here in Canada. And depending on how long this lasts, what will hurt is if a number of people who are in the early stage ecosystem say, you know what, I'm not going to go through this again. I'm just going to join a big company because, they have more resources to weather something like this. This is what actually happened in 2001. It's the very thing. And by 2005, that talent largely disappeared into large companies. So in the US, I think there is a more of a tendency to be entrepreneurial, and you'll see that as well there. I am a little worried about it, but we're not going to really see this until after we reopen up, because even the big companies are largely not hiring en masse, with minor exceptions, say like an Amazon. But if you look at the banks, for example, they're not really laying off, but they're being very, very prudent and careful too, that they're not adding hordes of people either.
Right, right. So I guess what weak points in the tech ecosystem have been exposed as a result of the crisis, and what recommendations do you have for founders today to survive?
So what COVID is doing, and this is my view. I don't think COVID in and of itself is really changing the direction of tech, or changing or creating new opportunities for technologies per se. What it is doing, it's exposing the pre-existing vulnerabilities or the pre-existing trends that were already there. Just like what I told you, the reason why we're going into a recession has nothing really to do with COVID, in my view. This was a long-time company, and it was actually really triggered by the US retreating from the rest of the global supply chain and going back and reverting back to its isolationist policy. What I didn't know was it needed a crisis of confidence trigger. It's the same thing with COVID. So let's talk about the easy and obvious one, work from home. There were a lot of people who really wanted to work from home. And the impediment was a lot of their employers who didn't think it was possible for them to effectively work from home. And the ones that I believe it makes a lot of sense is, if you are working for a company and you are part of a group that you really weren't working in a team. And I'm going to give you an example. And this may be a bad example, but I'm in a call center. If you were simply reporting to work, but largely working on your own based on a policy manual in front of a screen, like, why couldn't you do that at home? And if people wanted to do that, it was the company who said no. The companies are now going, oh my God, this was actually easier than I thought. Oh my God, and it's saving real estate. What a perfect fit. But I also don't think we're going to have people working from home and companies shut down and where no one's ever going to go in a downtown office building again. I call bullshit on that. And if you really believe that, aren't you the same company that really espoused how great your employee culture was? Aren't you the company that said how much your employees all love interacting with each other? Maybe you guys all hated each other, or maybe you had a shitty culture in there. I can't wait to see my team, not because I can't be more productive this way, but those serendipitous collisions of ideas, those small conversations are absolutely critical. And the person who said it best was Satya Nadella of Microsoft. He says, you're going to go from one dogma right to another dogma. To me, it's all about flexibility. So the work from home trend was already there. It just that it needed a critical push, right? And I think on a number of these things. So for tech founders, I talk about the difference of incrementalism versus really creating something new. If you are a tech founder in a virtual healthcare or in virtual education, and you are having problems for people to see what the benefit of this is, COVID has exposed this and has actually, in those cases, made it easier for you to convince some folks to see where the product market fit might be. But a lot of these companies were already thinking about it. So, what I'm doing with my team is looking at where our various themes were and seeing how COVID has either accelerated that or exposed something that we never thought about. And one area, as just one of many areas I just never thought about, is our manufacturing supply chain for critical and essential goods, particularly food supply and in healthcare. I got to be honest, I just never thought about it. This is a fascinating question. So did it always exist? It did, but no one gave a crap about it. Now they do. So I think the great thing on COVID, it's a great opportunity for people to really reevaluate the value of things that people just dismissed.
Right. It's like a wake up call for for founders who may have been beat down because C-suite executives just didn't want to change the way they were working. And so they ended up running out of money and resources before they got to the chance to have that seat at the table. Right. And now those executives are coming to them saying, hey, I need something to get transparency in my supply chain. Do you have a solution that I can use from work from home? They're like, yeah, I built it 5 years ago, but you weren't around to buy it then.
Exactly.
And so now you're saying, come back to me. I'm ready to have that conversation.
I just had this very discussion. By the way, that was the reason why I was 2 minutes late. That's what the discussion was. I won't tell you what the company is on there, but great solution, product market fit. They actually might become an essential industry now. And now they're running, oh my God, do I even have the resources available to actually execute it? Because now the customers contacted them.
Right, exactly. And that's when you know you have real, true product market fit. So
Correct.
That was behind our thesis on our investment in Rose Rocket too. You know, re-onshoring of supply chains, transparency, right. Efficiencies. So we're with you on that.
Yeah, and and by the way, if you're a founder that's caught on the other side, you know, my only advice would be, you know, now that you know that, you know, COVID might be exposing a vulnerability, you might need to move or pivot to that as well.
Yeah, absolutely. So pre-COVID, many U.S. funds were, chomping at the bit to make investments in Canada. Do you think this will change because of COVID, i.e. retreatment to their backyard deals, or will deals accelerate from U.S. funds in Canada?
So I don't know. And I haven't spoken to many of them yet, but let me use the 3 previous cycles, what tends to happen. And I can tell you this from a Canadian perspective. As a general concept, people revert and focus in currently on what they have. So if they have capital deployed locally and they have investments locally, there is a tendency to revert back to your own backyard, because that's where your reputation is. That's where your neighbors are. That's where your friends and employees are. And what happened in the last pullback is the US firms went back to their own backyards, where their reputations and where the bulk of their capital was being deployed. So, I would expect most to focus in on where their strengths are, and perhaps retreat back from areas that they were exploring. That's not the case for everybody, but that's the tendency, I think, on natural human reaction. I do know of a few folks that are saying, well, maybe this is an opportunity to move in a different direction when I didn't have the time to do that as well. So, but I think those are in the minority. So I would expect there's going to be for sure a retreat of tourist capital, for sure, whether that's Canadian or US, but most of it is US sourced. And then number 2, I think there will be a focus more back in your local place where your greatest strength is.
Right. I mean, VC is a local business, as it always has been. So maybe it's just go back to where it was in the beginning.
Right. So we just got to make sure we protect the Canadian VCs that are here already.
Yeah. This is a bit of a selfish question, but where do you think emerging managers such as ourselves at Ripple should focus our attention when it comes to areas of investment and stage, given the uncertain world we are in today?
So if you are an emerging new manager, and this is the dichotomy here, you're best positioned for the future, because if you don't have a lot of it pre-existing funds and portfolio, you're not focused in on fixing the problems that you have in your portfolio. And what if you have multi funds, the prudent thing that you really need to do is make sure to deal with what you have that you've already deployed, and making sure that the good ones don't fall away, which then means that an emerging manager like Ripple can really look towards the future, focus their energy disproportionately on the future. And if I'm right that valuations will start to pull back and revert closer to the long-term mean, that means your entry point is far more attractive. And the one thing that people seem to always forget, your job as a VC or investor is to find quality companies at an attractive entry price. Anybody can go and find the perceived, winners, which whatever that means, and throw capital on it at obscene prices, but you got to return that back. So you're not an asset or allocator, you are an investor, and you got to return that back. So in a market where there's good quality deal flow, and interesting deal flow at attractive prices, these are the vintage years over the last 20 to 30 years that proven out to be the greatest vintage years. So ironically, 2021 is probably going to be a spectacular vintage year. And the only reason why 2020 may not be that good is that, for the first half of the year, if you made investments, those will get hammered. Maybe you could make it up in the second half of the year, but 2021 will be a clean first year for attractive valuations.
Yeah, I appreciate that. Thanks, John. I guess, the fund life cycle can work for you or against you, depending on how you time it. So Hopefully we timed it right. Thank you very much. And thanks everyone for joining us today.
Great. Thank you. It was a pleasure.
Take care.